I'm here a day early because tomorrow's Juneteenth, but I can't let you go in to the weekend not knowing what went down this week. And because a lot has happened and probably something else is going to happen tonight, this blog is already too long as it is, so we just have to roll now. There was a peace deal, a Fed meeting, and a new Fed chair's very first press conference. A dot plot that nobody saw, or I guess I should say nobody wanted to see coming, and two quotes from big industry leaders this week that I think tell you more about where this market is going than anything the Fed said. Sunday morning, the U.S. and Iran announced a peace agreement. The formal signing is scheduled for Friday, tomorrow, in Switzerland. Gasoline prices fell below $4 a gallon for the first time since March, and oil dropped to $83 a barrel. The 10-year Treasury fell to 4.46% on Monday morning, and the S&P 500 on Monday opened up nearly 2%. That's the headline. But there's some nuance here that we need to dive into. The 10-year yield falling back to pre-conflict levels is going to take longer than most people think or want. The first target is 4.46%, which we hit, then 4.35%, then 4.24%, which is where things were before the war began. Getting there is possible, but getting there fast is not likely. The Strait of Hormuz doesn't open overnight, my friends. There's mine clearing, infrastructure repairs, and security guarantees. That is all going to take time. So the oil price improvement is real, but the rate relief will follow as the supply chain unwinds over weeks and months. The good news is that the worst of the year is probably behind us in terms of interest rates. The 10-year peaked at 4.68% during the conflict, which is when mortgage interest rates went as high as 6.75%. We are already off those highs, and if this deal holds, that means that ceiling has been established for us, and we hopefully won't break through it. Now on to Warsh's first meeting because the new sheriff said some weird shit. Wednesday was Kevin Warsh's first FOMC meeting as Fed chair, and the vote was unanimous, 12-0, to hold rates at 3.5% to 3.75%. That part was totally expected. What nobody fully anticipated was pretty much everything else that came after that. Warsh released a dramatically shorter policy statement. Gone was the forward guidance language. Gone was the easing bias. The statement, as Warsh put it himself, was curt, shorter and simpler, and no promises about where rates are going. He also declined to submit his own forecast to the dot plot, making him the only FOMC member whose rate outlook is officially unknown. He announced 5 task forces to overhaul the Fed's operations, covering communications, the balance sheet, data sources, the labor market, and, most relevant to us, the causes and measurement of inflation. Warsh was emphatic at his press conference. The Fed will deliver peace stability. The commitment to deliver is strong, unanimous, and unambiguous. And that's an important message we've missed for 5 years, and we're going to fix that. Now, here's the dot plot headline that moved markets. 9 of the 18 FOMC members projected a rate hike before the end of 2026. 6 of those 9 projected 2 rate hikes. The median estimate for the Fed funds rate at the end of the year has now moved up to 3.8%, up from 3.4% just in March. That was the projection. If you aren't assuming why Warsh didn't include his own projections, then I think you're missing the entire plot here. 3 months ago, the Fed was projecting a cut. This week, they projected a hike. The 2-year Treasury yield jumped 16 basis points to 4.21%. That's its highest level in over a year. The Dow fell 507 points, and the S&P 500 dropped 1.21% yesterday. The market's reaction to Warsh was not subtle. The curious thing about Trump, though, and this is the part I wanted to sit with for a minute because I think it is the most interesting subplot of this entire week. President Trump nominated Kevin Warsh to lead the Fed in hopes that he would push for lower interest rates. Trump has joked that he would sue his Fed chairman if he does not make money cheaper fast. And then Warsh walks into his first meeting and signals a rate hike? Trump appointed Warsh to cut rates. Let's be real about that. A wartime spike in energy prices pushed rate cuts off the table, and now Warsh is delivering a message that is the exact opposite of what Trump wanted, while doing it unanimously, confidently, and in the most hawkish first meeting a Fed chair has had in recent memory. I find this genuinely fascinating, guys. Warsh was supposed to be Trump's rate cut guy. Instead, he walked in and, in so many words, we're going to fix a 5-year inflation problem and we're going to do it regardless of what the political environment wants. Damn. I'm getting more curious about what his personal forecast on that dot plot would have been. Whether this is a good policy or bad policy is above my pay grade, of course, but what I can tell you is that it signals something important for rate outlooks. The bond market is predicting at least one rate hike. They've been saying that for months. This week, the Fed caught up to what the bond market's been predicting, and that alignment might actually be stabilizing, even if the message itself is uncomfortable. And stability in the market is what we've really been needing for buyers. The Fed is not cutting rates to make everyone happy. They say they're going to fight inflation until it is at 2%. Right now, it's at 4.2%. So we know that a market does really well for buyers when interest rates are just below 6.25% and when there is stability, not the volatility we've been dealing with. Okay, so the last quote you need to hear. In the middle of all the Fed drama on Wednesday, Bill Banfield, the chief business officer at Rocket Mortgage, said something in a CNN interview that you and I really need to pay attention to. He said, and I directly quote, home sales are responding more right now to the labor market than to rate moves. If the labor market remains healthy, buyers will continue to enter the market regardless of whether the next move from the Fed is a cut, pause, or even a hike. What did you just say, bro? The chief business officer of one of the largest retail mortgage lenders in the country just said home sales are no longer driven by interest rates. They are being driven by jobs. That is exactly what the data has been showing for months, actually. U.S. employers have added an average of 188,000 jobs per month over the last 3 months. The May jobs report added 172,000. Unemployment is holding at 4.3%. So, based on the data, the labor market is not breaking. And according to Rocket, the company that processes more mortgages than actually anyone, this is what is actually moving buyers, not the rate sheet. That reframe matters enormously for my buyers and for how realtors should be advising their clients. If a buyer's waiting for interest rates to drop before they'll feel confident enough to act, the Rocket data suggests that strategy has a flaw. The buyers who are moving right now are moving because they have jobs, they have income, and they have decided that waiting is its own kind of risk. They're not waiting for a rate. They are responding to their own economic reality. Imagine that. That is the confidence tax beginning to lift in real time. So we have two forces pulling in opposite directions. Here's the tension this week created that I think we all should sit with. On one hand, the peace deal removes the primary driver of the inflation spike that we've experienced since February 28th. Oil down means energy prices down, means CPI down over time. Means the Fed has less reason to hike. On the other hand, consumer prices are up 4.2% year over year in May, and that's the highest annual increase since April of 2023. Not much later, after April of 2023, is when interest rates hit 8%. PCE inflation is running at 3.8%. The data does not care about a peace deal signed Sunday just yet. It reflects what happened before Sunday. And that is what the Fed is looking at as they make decisions. Goldman Sachs, I think, put it really plainly. Our base case remains that the Fed can just about avoid hikes, but the path is narrow, and there might be a high premium on the incoming inflation data. Narrow, I think, is the right word. We're threading a needle here. The peace deal is the hopeful force, and the inflation data is the resistant one. And Warsh is the newest variable. So what does this mean for buyers and sellers? Let me bring it home. If you are a buyer, here is your honest picture. Rates are not dropping dramatically this week or next, but the ceiling has likely been established. In my opinion, the peace deal removes worst case scenario. The Rocket data tells you the buyers who are winning right now are not the ones waiting for a better interest rate. They are the ones responding to a healthy labor market and a motivated seller.